Hello. This is part 2 in the series titled Deconstructing the Black Magic of Securitized Trusts.
How the mortgage-backed securitization process is hurting the banking industry's ability to foreclose, and proving the best defense, or a foreclosure defense?
In our previous video, we tried to explain the basics in the securitization process and why it is turning out to be a nightmare for the banks as it relates to homeowners defending their homes in foreclosure court, using the bank has no standing to foreclose argument. In this video we will go in depth into just what securitization is, and what the banks did wrong.
Perhaps the most confusing issue when dealing with securitized trusts and what those trusts mean with regards to foreclosure standing is understanding what securitization is.
While there are many explanations, some lengthy while others are brief, understanding the process of securitization and the repercussions from a defensive perspective can truly allow for a crucial offensive strategy.
It is essential for any lawyer or judge involved in the foreclosures to understand the process of securitization, the key components, the deadlines, the contractual obligations of a trustee and a servicer, and how the failure of certain procedures or parties can lead to a nightmare for a foreclosing trust, and potential salvation for homeowners trying to get out of the financial nightmare.
A simple definition of securitization is a process where thousands of mortgage loans are bundled together into financial products called mortgage-backed securities. However, this is an oversimplified definition that does not give true credit to the structural complexities of MBSs.
A complex definition of the securitization process requires an explanation of the key steps, and how they interact with one another. The first stage occurs when a sponsor financial institution bundles mortgage loans together.
This bundle is created from loans either originated by the sponsor, or purchased from third-party originators such as small lenders or mortgage brokers.
The next step involves the sale of the bundled mortgages to a subsidiary created specifically for this purpose, known as a depositor.
The depositor is created for this purpose because it has no assets or liabilities other than this single bundle of mortgages, and this step is very important because it ensures bankruptcy protection for the sponsor.
The third step occurs when the intermediary depositor sells the loans to a passive entity, in case of residential mortgages the trust, which is designed to hold the mortgages and to issue securities which are repaid from the mortgage payments made on the loans.
The initial purchase of securities provides the capital to pay the depositor and sponsor for the loans. The trust can issue securities one of two ways, either directly to the depositor as payment for the loans who is then responsible for reselling the securities, or to investors directly, using the funds from the direct sale to pay the depositor.
The Congressional Oversight Report published in November 2010 notes that for proper securitization, there are at least 3 points at which the mortgage in the note must be transferred during the securitization process in order for the trust to have proper ownership of the mortgage in the note and thereby the authority to foreclose if necessary. The final stage of securitization involves the sale of the mortgage-backed securities based on the risks they presented. Each bundle of mortgages is divided into different levels, in what are commonly referred to in the finance industry as tranches, and then rated based on their creditworthiness.
Tranches are then assigned a different credit rating by a credit rating agency. Each tranche is a portion of the risk on the loan. Therefore, the higher rated portion, those given a AAA rating, down to an equity rating.
Those who receive a portion with the AAA rating are repaid first, have the least risk of loss, but also the lowest possible return on their investment.
The lower you go down in the ratings, the higher the rate of possible return, but the greater the risk. Once the securities are broken down into tranches, the rating agency has to try and judge the quality and value of the assets in each tranche. Bittner uses the following analogy. Think of it this way. Imagine taking 10 different vegetables and pureeing them in a food processor until you have something close to soup. Ask someone to identify the ingredients but don't let him taste it. Make him rely strictly on his sense of sight. Your concoction is sure to make him wonder what's inside.
As noted in a New York Times article, AAA failure Published back in 2008 when the ratings began dropping drastically on mortgage-backed securities following the beginning of the real estate implosion. Obscure and dry seeming as it was, this business offered a certain magic. The magic consisted of turning risky mortgages into investments that would be suitable for investors who would know nothing about the underlying loans. To get why this is impressive, you have to think about all that determines whether a mortgage is safe. Who owns the property? What is his or her income? Bundle hundreds of mortgages into a single security and the questions multiply. No investor could begin to answer them. But suppose the security had a rating. If it were rated AAA by a firm like Moody's, then the investor could forget about the underlying mortgages. He wouldn't need to know what properties were in the pool, only that the pool was AAA. It was just as safe, in theory, as other AAA securities.
When mortgages held in securitized trusts began defaulting at alarming rates, the rating agencies began performing mass downgrades on their ratings, adding fuel to the belief held by many experts that they had been artificially inflated from the beginning.
While the rating agencies are certainly to blame, government regulation by the SEC was also lacking, making it easier for rating agencies to rely on bad or incomplete information to inflate ratings.
Of course, long after the damage was done, the SEC began investigating whether the ratings agencies were guilty of fraud by failing to meet their due diligence requirements, which would have allowed them to adequately rate the mortgage-backed securities.
All in all, it just goes to show that numerous institutions on Wall Street and the United States government through its various agencies all contributed to this mass crisis. A crisis for which the American public is paying the price.
And here ends this edition of Deconstructing the Black Magic of Securitized Trusts.
We hope you'll join us for the next in our video series.
How the mortgage-backed securitization process is hurting the banking industry's ability to foreclose and proving the best defense for a foreclosure defense.
And remember,
only with a thorough understanding of how the securitization was supposed to work, can we learn what was done wrong in each of our own home's loans.
And learning what was done wrong is our best defense to beating these banking giants at their own game. They want us to think this is rocket science.
It is not.